everyone. Welcome back. Welcome back to another session in our webinar series of going live in 30 days. Okay, so let's begin, right? So today I'll be sharing with you guys from an institutional perspective, like what is my take on supply, demand, trend lines, and indicators. You know, how I use them to trade, right? So the agenda for today is at the beginning, we're just gonna go through really quickly how does supply and demand work. I'll be showing you guys like 3 types of supply and demand setups. Okay, these are the ones that I prefer the most. After that, we look at trend lines, you know, rules to obey, right? My personal take on trend lines, you know, the good, the bad, the ugly, right? And how we can better utilize them, all right? After that, we look at the channel, which effectively a channel is actually just 2 parallel trend lines, if you think about it. So we'll be looking at a channel. One particular indicator I think is pretty good to combine with this, with what we're learning today, is the Ichimoku Kinko Hyo, which means charts at a glance. All right, and the last one is I'll show you how I usually combine these together to find basic setups. Right, so I think the next few sessions we'll be looking at a little bit more advanced, like price action, trade management, and crafting of strategies. And this actually forms a foundation, right? This forms a foundation to our strategy. Okay. Now I see Gagan asking what's my indicator. I'll be showing you guys later, so stay till the end of this webinar as I'll be showing you guys how to get the indicator. Right, and I'll be showing you guys the indicators I use too in my own personal trading, right? But always remember, I combine the indicators with my own analysis to find setups, right? You don't just rely on a single indicator as a silver bullet kind of thing, right? So anyway, before we begin, same thing as always, disclaimer. You know, CFDs are complex, it's risky. And please do your own do your own research, or ask me questions before you take any trades. And nothing that I share today should be constituted as like investment advice. So please, just a word of caution there. A little bit about me, right? So today I'm your host, Desmond Leong, right? I run an award-winning research firm, Average Fortune Group, and of course I also run the little crazy place called the Forex Army, right? Best FX and best equity research for 2019 and 2020. And the stuff we come up with, is come up with a team of CFA, CMT, and CFT accredited traders. I love to build indicators. I love to build EAs. I love to build stuff that make trading easier, right? So I see Milan asking me if I have an Instagram. I can share with you guys later. Yeah, I have my Instagram, but it's not like those cool Instagram traders where where they're in the Lamborghinis and stuff. Most of my Instagrams are about my cat, playing my cat, going jogging. Yeah, it's nothing fancy. But yeah, if you want, again, I can share with you guys later. Now, how does supply and demand work? Wait, I'm seeing some questions come through. You watch for oh yeah, James, I think you're talking about the trade manager from the first session. That is a special indicator, which we also built, right? And I can share with you how we can get it later, perhaps. But today, first, let's talk about supply and demand, okay? And I'm going to take up my where is that thing? My pen. Oh yeah, it works now. Okay, I thought it might have run out of ink or something. That's such a lame joke. I'm sorry. Now, supply and demand. This is the basis, right? This is the basis of how the markets move, right? At any point of time at a market, right? What determines if the market goes up or goes down? It's just basically buyers versus, good heavens, buyers versus sellers. Right? If there are more buyers, it will go up. And if there are more sellers, it will go down. Right? So if there are more people buying in a certain place, that's called the demand zone. Imagine, everyone wants to buy Apple, right? Maybe even iPhone, right? Everyone's there's a huge demand for it because there are a lot of buyers for it, right? So think about it in that sense. That more buyers, it tends to push price up. And if maybe something like Samsung, right, or maybe Huawei. Now, after Google banned them, no one wants their phone. So suddenly there are a lot of people who are trying to sell it, right? Because their phones just don't work that well anymore without the Google Play Store. So suddenly everyone's trying to sell it. And if there are a lot of sellers, it kind of pushes the price down, right? There's an oversupply and it pushes price down. Now, so this is the basis of how price moves up and down, demand and supply, right? So today I'll be sharing with you how I identify these zones. Remember, I'm talking about zones here. Okay, it's a very important thing to note. Why we're talking about zones is because if you notice, there's a reversal here, but this reversal might be slightly higher. This reversal might be in the middle, right? Price always works in the form of zones. It rarely ever works at a single point on line, right? It rarely ever happens at a single price. You're always looking for a zone. Okay, same thing for for demand. You can see a bounce here. This bounce was slightly lower. This bounce was slightly higher, and this was slightly higher. So this is more or less a zone. So the first thing I want to teach you guys is that don't just look at a single level. Many of the supply and resistance or support and demand kind of indicators out there, they tend to focus on a single level, which rarely ever works. You need to buffer yourself, like maybe a range of pips, right, for you to find these kind of zones, right? It's never ever a single level. Okay, now moving on to three kinds of supply and demand kind of setups that I look out for, and this forms the basis of all my this forms the basis of all my setups, right? The first one is called the swing high and swing low. Okay, I try to look for at least three, right? So when I talk about swing high and swing low, I'm talking about dramatic levels, right? Significant levels. What I mean by that, so you can see this is one swing high over here, right? Another swing high. This is the third swing high. So if there are three swing highs, I know that price has respected this level 3 times. So I will tend to look out for a fourth swing high. This would form the basis for me to look for a potential setup, right? Because once price has obeyed it at least 3 times, right? For me, it's at least 3 times, right? That tells me that it's a big area of interest to look out for, right? Even if it's just 2 times, I think it's coincidence. 3 times, then I would more or less just say that, okay, it's a level that we can definitely look at, right? And then this is, of course, the fourth swing high, and we sell from here. Do I just sell from here this easily? No, I actually combine it with different kind of indicators, which I'll be sharing with you guys later, right? So the concept of trading is always thinking in terms of probability. Okay, what I mean by probability is that if you find one support and resistance, right? Support and resistance, maybe if you get 3 swing highs, right? Maybe you have a 30% probability of a successful reversal. If you get these just swing highs. If you get coincidentally also a trend line that happened to be lining up here very nicely, that could add on maybe 10%. Right? If you are stochastic, right? If your stochastic was also at a big level, we could add on maybe 15%, right? And if you add in other stuff like correlation, RSI, you can maybe add on another 5% here, another 10% here, right? But by themselves, if you just trade a single strategy by itself, right? Maybe just support and resistance, 30% by itself might not give you an edge over the market. You might see some wins, you might, out of 10 tries, you might get 3 that are profitable. But it doesn't give you a big enough edge over the market. If you combine it with maybe like trend lines, 40%, you combine it with an oscillator, become 55%. You combine it with correlation, could be 60. You combine it with maybe Fibonacci, becomes 70%, right? It's all about adding up the different indicators together to find a high probability setup. Right. Of course, just to find 1, 2, 3, 4, 5 things that line up very nicely at a single level, there are probably less chances to see that. But in trading, right, if there's one advice, one philosophy that we can go by is that we make more money, sitting out of the market than jumping in every single time, right? It's about waiting for the right setup. You got to think of yourself as a sniper, right? Think of yourself as a sniper, waiting for the correct moment to take a trade. And once all the conditions are right, you can go in for the kill, you make the trade, and you make money. Guys, one thing I want to remind you guys is that when you're trading, you're not trading for the sake of trading. You're trading for the sake of earning money, right? Trading is just a method you use to earn that money. You can be juggling balls, you can be busking, you can be doing a lot of different things to earn money, right? Trading is just a means to earn the money, right? So don't trade for the sake of trading. Always remember that. Okay. Now, the first thing that I'm sharing with you guys, of course, is the swing high and swing low setup, right? My rule is always to look for at least 1 to 3 swing levels before I look for a fourth one to play a reversal from. The next one I'm going to look at is what I call the pullback support. Okay, let me share with you the story of the pullback support. Okay, now imagine price came up to here, it dropped one. It came up to here, it dropped a second time. It came up to here, it dropped a third time. Right? When it comes up to here, what do you think people are going to do? Right? Please participate with me here. Type it in your question in the little box. Do you think people are going to buy or sell? Okay, I see some people saying sell. I see Narvin saying buy. Charlene is saying buy. Charlene, why are you saying buy? Jamila saying buy. Well, it seems like a lot of people are saying buy. Well, quite a few people saying sell too. People sell since a supply zone. Sell when trading resistance, buy for breakout traders. True, there are two kinds of traders: reversal and breakout traders. So that's good insight there, right? So traditionally, what most people tend to do is they try to sell. Okay, there are the breakout traders and there are the sellers. The breakout traders give the momentum for it to really rise out here. Sorry. A breakout trader really gives it the momentum to rise up further. But many people are trying to sell over here. So imagine they're trying to sell and they're like, it's going down, it's going down. That's great. Then suddenly it starts to go up and holy smokes, it just shoots up. What is going through their mind now? For those people who sold their positions here, right? What's going through their mind now is that they're thinking, oh man, I will never ever trade again. This is terrible. I can't believe price is, doing this to me. The market is manipulating me. Oh my goodness, what should I do? Right? So, after countless nights of not being able to sleep, cursing the heavens, and whatever people do to get blame the market, right? Price finally starts to come down, and price starts to come down. And they think that there is hope in the world. Maybe there's a God. Humanity. There's hope for humanity once again. And once it comes down to here, what are the people who sold over here? What are they going to do when price finally reaches here? Are they going to sell again for hoping that price will go down, or will they close off their positions? What will they do? You can make a guess, guys. Milan, I see you saying is sell. Yeah, Raylan says it's break even, close the position, hang on, don't close, reverse, go long, sell, buy and close. Yeah, a lot of them, right? The majority of you guys says that they're going to close off the position, right? Because they just had one hell of a ride, and at this point, they just want to close off their positions. When they close off their positions, right? Remember, they have a sell order over here. So when they close off their positions, they need to buy, right? Essentially, they need to buy. And what happens is that it pushes the market up, like we talk about demand and supply. Of course, there is a whole bunch of people, waiting to play this thing called the pullback support. The pullback support, I don't just want to tell you the setup. I want to explain the psychology of it behind. Psychology of the psychology behind it to you guys, so that you better understand the reason why you see these kind of setups happening very often, where it kind of makes a pullback and then it bounces off, right? So this is what we call the pullback support and the psychology behind it. Now, for those people, those breakout traders, right, they could be waiting for another time for price to pull back to get in at a better level, right? So breakout traders always love it when the market breaks out, pulls back a bit, and then bams, right? So this could be the pullback they're looking for it to really take off, right? So let me just read what Gerard is saying. So Gerard is saying that if they had a stop loss in the first position, their position would be closed already. So you're opening new positions. Sell as markets bounce off the. So yeah, in a perfect world, everyone would be super disciplined to have stop losses over here, over here, right? But sadly, we're not in a perfect world, and many people do not have stop losses, right? Even if they have stop losses, they tend to move their stop loss, or they tend to keep their stop loss very far, right? So and this could be the H1 chart. So someone could have someone could be trading the same move but on a higher time frame. So it doesn't affect them that much, right? But anyway, not everyone goes through the XC webinar, so you guys have an advantage knowing how this works now. Okay, so with the pullback support, we also have the pullback resistance. Okay, the pullback resistance functions the same way, same thing, except that instead, price breaks down and is looking to make a pullback to this level. Once it makes a pullback, the same thing, all those people that were hoping for a bounce over here, they start to close off their positions and it reverses. This is how it looks like in the markets, right? This is how it looks like in the markets. You can see there's this big level over here, right? Big level over here. And price has reversed since then. So this is what we call a swing high resistance. Okay, the moment price surpasses this swing high resistance, it becomes this thing called a pullback support. Okay, you can see it surpassed that, and it's now a pullback support. Now, once price has made a successful pullback, right, this is where I'm looking to play the bounce. Okay, so this part here, the moment it passes there, this is what I'm calling a pullback support. Okay, when price bounces up, it turns into our last type of support. Okay, when price finally bounces up, it becomes what I call the overlap support. Okay, it becomes the overlap support. Overlap support are where price react off it one time from the bottom and bounce off it one time from the top. So it shows that there's agreement between the buyers and sellers that this is a key, what I call inflection point. This is a key level people are now looking at. Okay, so there are three moments here. One is when you see the swing high, one is when you see the pullback, and one is when you see the overlap. Okay, so these are the three kind of key levels I want you guys to keep a watch out for. All right, keep a watch out for when you're trading. Okay, now before, okay, you know what? I think most of you guys would understand this pretty simple concept of supply and demand, support and resistance. If you have questions, remember, don't wait until the end of the webinar to ask them, because you've seen it. You've seen how it was previously. We had no time. We have no time to go through any of the questions, right? So if you have questions, straight away shoot them across, and I'll do my best to answer them. I literally have another screen open here, just monitoring the questions that you guys are sending through. Okay. Now, now that we've covered support and resistance, the next thing I'm going for is trend lines. Okay. Now, trend line. This trend line, is it a yay or is it a nay? Right? Do you think it's good, or do you think this is a bad trend line? Right? Guys, participate with me here. Do you approve of this trend line, or do you disagree? Wow, I see a overwhelming number of people say it's good. Some people say it depends on the time frame. Not sure. Duko, you disapprove. Why do you disapprove? You can share it with me. right? About the majority of you, I say 90% of you guys have approved lower highs, lower lows that defines the trend, right? So okay, if you're yay for that, what about this? Do you guys approve of this? Is this a yay or is this a nay? I'm seeing people say yays. I'm seeing people say nays. Yeah, we're getting a little bit different response here, right? A bunch of people, you know, it seems like there's a little bit more, it's a little bit more different, right? The answers. This one because it starts from the topmost candle. Yay, I usually connect wicks. Yeah, some people usually connect the wicks. Now, what if I told you this and this, right? They are the same. This is the H1 chart. This is the H4 chart. They're the same. Okay. Now, for the first one, we had an overwhelming, maybe 90% of you guys said yay. For the second one, maybe about 60% of you guys said yay. All right. Now, you see the problem here? It's the same chart. It starts from the exact same point, right? It's just that one uses a lower time frame and one uses a higher time frame. So this is what I want to share with you, is that trend lines tend to be subjective, okay? Because a week over here, right? Some people say they want to connect the weeks, right? But it may appear as a week on the H4 chart, but it might not appear as a week on the H1 chart. You know, H1 chart looks like it spiked all the way up to here. So some people were saying, hey, you didn't factor in this spike, right? But you know, in this case, you know, it doesn't look that bad over here. So, and over here it looks like, you know, it catches the wick perfectly. But if you go down here, you know, it depends how you look at it. You know, it might have spiked up a little bit more. So it really depends, right? Trend lines, I tend to use trend lines to determine momentum and as what I call a supporting argument, right? Remember, trend lines, I call them supporting arguments. Who can make a guess what a supporting argument is? That's just supporting. And that's your main argument. Yes, I see James say confluence. Yeah, confluence. Wow, two people said confluence at the same time. Not bad, confirming. That is correct. Supporting argument means that you don't, it's not the main thing that you would use to trade. Yeah, it's not the main thing that you use to trade, right? You might have a main thing. The main thing could be, you know, swing high resistance. It could be pullback kind of resistance. It could be Fibonacci. But trend lines are more of like a supporting argument for me, right? I don't use them as my main reason to trade. I feel that it is too subjective. Some guy might have taken this as the swing high, right? And if they take this as a swing high, they might take this as a level, right? Because if you draw this level this way, you know, you might end off in a very, very different place. A small change in your angle will lead you to a very, very different outcome, right? So would they have cut off this level and just take this spike the same as me, right? Would they have factored this in? Would they allow this, right? How, you know, it's very rare that, you know, everyone agrees on a single level. That's why supply and demand zones are a little bit more universal, right? And instead, you know, if you're talking about 10 pip difference in supply and demand, you know, it can still be a decent level, right? Whether there's this level here and this level here, right? They might be different by maybe just 1 or 2 pips, right? 1 or 2 pips, and it is still a level that we can look at, right? This is still a very decent level to look at. But if we look at, so that is for horizontal. If you look at diagonal levels, right? A 1 or 2 pip difference over here, whether you're taking this one here or this one here, can lead you to here or here, completely different setups. Okay, so that is the danger when it comes to trend lines. Trend lines are a lot more unforgiving, right? Different brokers might have different price feeds. Someone might be using the H1 chart, you know, someone might be using the H4 chart like this, right? And they might all lead to different kind of different answers, right? Different kind of interpretations, right? And if no one can agree on the same, you know, if no one can agree on the same levels, then your strategy is weaker, Because you might be thinking, oh, it's time to go in, all the sellers, let's get in right now over here. But then, if someone else is using, use this as their trend line instead, right? They might be waiting for, they might be waiting at a point that is maybe slightly further, right? So that's the thing about trend lines. Use it as a supporting argument. Now, this thing over here, right? This trend line, is it a yay or is it a nay? I see many people saying yay. Peter, you said nay. Can you share with me why you said nay? Okay, some people say, I think yay. What about the rest of you guys? I got a whole bunch of answers. I haven't got the other answers from you guys. Peter, I love your answer. So Peter has said downtrends are usually measured off the top. And he is correct, right? What I mean is that if you're taking a downtrend, all right, in this case, we can agree that price is making, is going lower and lower and lower and lower. Okay? A trend line is usually taken from the top. It's not usually taken from the bottom. It could be a channel, right? It could be a channel, and we will go into that later. But in this case, right, one thing I want to share with you guys, and it's exactly what Peter mentioned, right? And it's quite scary because he was the only guy who mentioned it over here, is that trend lines, if you're getting a downtrend, right, you should be taking levels from the top. Your trend line should be from the top. Lee, I'm sure you knew that too. You're just being humble, right? They want to share. Yeah, trend line should be from the top. And if it's an uptrend, your trend line should be from the bottom, like an ascending uptrend. Okay? So remember, if you're seeing a downtrend, like in this case, your trend line should be from the top. All right? So this case would be wrong. So for all you guys who say yay, be careful, right? You don't want to look for a pattern like this, where the trend lines are bouncing from the bottom. Okay? Now, rules to obey for trend line. Personally, myself, I call it 3 significant touches. Okay, you need at least 3 significant, and the keyword here I'm saying is significant, right? Why I'm saying significant is because many people, I see them, right? They see this thing here, like 1, 8, 2, 3, and they're like, oh wow, a trend line, that's great, right? This is not significant, right? This is, this is nothing. It's not significant enough, for you to consider that, there was a big reversal from here, there's a big reversal from here, and that's another big reversal from here. So once they have 3 that have lined up nicely, right, then I will consider it as a valid kind of trend line. Personally, my preference is 3, right? You can increase it, right? 2 to me is still a coincidence, right? 2, 3 tells me that there's more people looking at it, right? So Milan just asked this question, whether is your trend line bad if you draw it, for example, on the 1-hour chart, but it does not correspond on the 4-hour chart? And we got another question from Raylan saying, which time frame is the best it should be used, right? So when it comes to the basic concept of trading, right? How many of you guys, okay, let's just say, we have the 1-minute time frame, 5-minute, 15-minute time frame, right? Then of course we got a 1-hour time frame, we got a 4-hour time frame, we got a day 1 time frame. Okay, which time frame has the most noise? Okay, yeah, unanimous answer. 1 minute. Okay, we got some guys saying 5 minutes. Well, the lower time frames, right? Even 1 minute and 5 minutes do have quite a bit of noise, right? What happens when there is noise? when there is noise, there are this thing called wicks. Okay, there are these big wicks that happen, right? Because it's just moving so fast, right? And the wicks tend to be very, very high. Okay, when there is noise, right? Imagine, like, you know, whether you're doing work or something, when there is noise, right? Someone's doing construction, we're not able to do our work well. We get distracted, correct? So it's the same thing with trading. The lower the time frame, the more noise there is. The more noise there is, if I told you that, okay, I want you to connect a trend line only using the wicks, right? Because there's so much noise, right? You know, there's so many wicks spiking up and down everywhere, right? You might not be able to connect a proper channel. And because of that, you're not able to, you're not able to trade effectively, right? So based on this theory, right, you want to, usually for this kind of channels, trend lines, right, if you really want to avoid the noise, I tend to go to at least the 30-minute to the 1-hour charts. Those help me. Those are the lowest I would go, right? Those are the lowest I would go to look at to look at, what's the word for it, to look at trend lines and channels, because, you know, it helps remove quite a bit of the noise. Another thing I would do is I would let me see if I can find it over here. Okay, so this is my chart usually. Okay, so this is my chart. Let me try to find something. So if I'm drawing trend lines, right? If I'm drawing trend lines, I will try to avoid things like this. Okay, I will try to avoid things like this, right? If for some reason, let's see, if for some reason I'm trying to draw a trend line from here to here, and I'm hoping to, like, play whether it's a few more bounces or something, I would stay away from this kind of big spikes. Okay, the reason why is because there clearly was a big fight over here, right? Different brokers, different price feeds. Always remember that. Different brokers, different price feeds, they might fluctuate by a bit. Okay, now if this broker, right, his spike is all the way down to here, if there's another broker whose spike is lower, you could end up be over here. Another one who's slightly higher might be end up over here, right? And because this periods of high volume and volatility, right? Right. Okay, Manoj, catch you later. Right. This period of high volatility is that it's better to, if you're drawing a trend line, I would avoid these moments. I would go for the clearer moments like this, where there wasn't too much fluctuation, right? There wouldn't be cases where there's just a massive fight over here, right? So those are the things that I would kind of watch out for and be careful, right? When I'm trying to draw trend lines. Okay, I think if you go down to the 1 minute chart, right, we can probably see there's a lot of choppiness everywhere. Even the 5 minute chart, right? Even the 5 minute charts, you can see is very choppy, right? And there are wild spikes everywhere, and it isn't like just looking at it over here, right? You can see the way the bars look like. There are big gaps everywhere, right? There are gaps in forex is crazy, right? But there are big gaps everywhere. And if you compare this to the 4-hour chart, you can see it is cleaner. Okay, it is cleaner. When you just scroll back, you can see the movements. Okay, maybe it's not so much cleaner for this particular pair, right? But yeah, it's the higher the time frame, the less noise there is. Okay, yeah, Flava, I tend to like the 30 minutes too. What's better, connecting wicks or bodies? So I have a question from Lee saying, what is better, right? Do I connect wicks or do I connect bodies, right? So let's take a let's do a poll over here, right? When you're connecting stuff, right, is it better to connect the wick over here, or is it better to connect the body? What do you guys think? Okay, just you guys can continue typing while I just look for maybe an example right now. Wow, almost everyone says body. Okay, George says, body because wicks can show rejection. Say obvious trend, right? The whole wicks are zones to watch out for. Unlike Cicero, interesting, right? Wicks are spikes, right? Just after the body. Okay, so majority of guys say, majority of you guys are saying a body. Okay, now let's do a let's do a example over here. Just let me see if I can find when I can find other levels. Okay, never mind. We just use this one over here. Okay, in this case, right, we're trying to connect most of the wicks, correct? Besides this wick, we're kind of just trying to touch most of the wicks. Okay, we use another case. Maybe a different color line, and we connect the bodies. Okay, maybe in this case we use it as red. Okay, we try to connect the bodies over here. So black is connecting the wicks, red is connecting the bodies. Okay, now what if we change it to the 15-minute chart? Oh shoot, where did it go? There. Which one looks nicer, the red or the black? Guys, which one looks nicer, red or black? Okay, it's about 70% who say black and 30% who say red. Now let's go to the 5-minute chart. Okay, I need to find that thing there. Which one looks nicer, red or black? Sorry, I can't zoom in too much because it's yeah, I can't zoom in too much. I see a majority of you guys say black. All right, Sam's still saying it's red. Now, why does black look nicer, right? Now, even if you go into the 4-hour time frame, to me, black looks nicer. 4-hour looks nicer. 2-hour looks probably looks nicer, right? 1 hour, even go down to the smaller time frames, black looks slightly nicer. Now we're on the 15 minutes time frame. Where is it? Yeah, on the 15 minutes time frame, black definitely looks better. Red is just cutting through like this whole bunch, and over here you can see that it's like kind of just cutting through this, right? Why? So based on this, should we take the body or should we take the wick? I see a lot of you guys saying wick now, because the wick, right? The wick is the ending point. The ending point, irregardless of whatever time frame you are on, right, is the same. The ending point on the 5-minute to the 15 to the 1 hour to the 4 hours are the same, but the closing is different, right? The closing is different. Like you see over here, 15-minute chart, what looked very nice on the 1 hour chart doesn't look nice, on the 15-minute chart, right? And doesn't look nice on the 5-minute chart, right? Because they all close at different times, right? But what they all can universally agree is that this was the maximum price, maximum level that price had went to, if you're using the wick, right? So in this case, right, if you're asking whether I tend to use the wick or I tend to use the body, my answer is that I tend to use the wick, right? Because bodies can change across many different time frames as you toggle them, but wicks will remain the same, right? The wicks is just the maximum level that price went to, right? So I hope that kind of answers this question for you guys. We have a question from Milan. Can you answer the question about the trend line lines up on different time frames later as well? Well, Milan, I think that this actually shows you what I mean. That is, you don't need all the time frames to line up super nicely, because they all show different things. And if you tend to use the wicks, right? If you tend to use the wicks, you will tend to have better outcomes, right? Because you know, there's whether you're on the 1 hour, 5 minute, 15 minutes, more people will agree with you than if you use the body. Okay. Now, back to the webinar, right? Okay, digress a bit. Yes, wick represents the extent of the price. That is exactly correct, right? So next thing I want to show you guys is oh yeah, this is exactly how it looks like. You notice that the reversal that we were calling from previously, right? It just reversed from here. Again, I tend to prefer to look at it as a zone, because I think there's a lot of fighting that kind of goes on around there. So I would try to look for it as a supporting argument. So maybe in this case, if there was another swing high over here, right? If there's a Fibonacci extension over here, right? Multiple things line up together, then I would take the trade. So I would never ever use trend line as the sole reason to kind of trade alone. Okay. For channels, is this a good or is this a bad channel, guys? Okay, let's participate here. Oh, Charlene, I see a question from you asking which time frame is good to draw the trend line. For me, I tend to draw it from the 30 minutes onwards, and I tend to try to look at the wicks, right? Oh, almost everyone says it's good, right? To me, yeah, it's a good channel, right? And price actually continued to obey it very nicely, right? You can see after it bounced from here, right? It actually bounced, react from there and from the bottom, right? One thing I tend to look out for, right? Is I tend to look out for 2 at the top and 2 at the bottom, right? So you'll say, Ramirez, yeah, I try to look out for 2 at the top, 2 at the bottom, minimally, right? For me to confirm a channel. If it's 2 at the top and 1 at the bottom, it's not counted, right? Because when this happens, then it shows you that there is a parallel line, right? 2, 2. So total, you're looking for 4 significant touches. To more or less confirm a channel. 5 would be great. 4 is like the minimum I would go for. Okay, so this is definitely something to consider. Okay, 3 at the top and 1 at the bottom. Milan, not really, right? Because 3 for there to be a channel, you need 2 parallel lines to happen. Okay, for there to be a channel, you need 2 parallel lines, right? In this case, right? So imagine if you only okay, let me draw something else. Imagine if you had 1, 2, 3, 4, 5. If you had 5 at the top, right? Is this considered a channel over here? Would you consider this a channel, guys? Yes or no? Hey, Dan, you're saying yes. Why are you saying yes? Cesaria is saying yes. Why are you all saying yes? You're confusing me. What is this thing connected to? Right? There's unless this point kind of comes down to here and comes up, then you're connecting 2 parallel lines. Otherwise, this is just a random line that you're drawing. Okay. Yeah, this is just a random line. This is a very nice swing, descending line, sure. But you need for there to be a channel, you need 2 parallel lines to happen. Right? So you need at least one more, need at least maybe this thing to come down to here. Then maybe you have 2 parallel, you have a channel. So remember, always at least 2 at the top, at least 2 at the bottom, right? To be considered a channel. Right? For channels, if you notice, I'm not too particular about the wick, right? Because for there to be a channel, usually, just the mere fact that it needs to be parallel, right, makes it a lot harder to find channels, right? So even though there might be a little bit of a wick down here, it doesn't bother me too much. Okay. Do the significant touches need to be consecutive? No, John, it doesn't need to be consecutive, like I shared with you previously, but it does help if it's consecutive. Okay. Okay, so now on to the next one, Ichimoku Kinko Hyo, charts at a glance. Who uses Ichimoku over here? Right, I see some people say yes. Use EMI, EMA RSI, not yet. Some reading about it. Nope, don't understand them. I don't blame you. Right? I mean, guys, look at this Ichimoku, right? It is messy, right? It is messy, right? And there's a lot of math behind it, right? But there's one thing. If there's one thing I like to do when I use Ichimoku, I use it as a supporting argument for sure, right? Ichimoku doesn't work like Bollinger Bands, right? And yeah, Duko, naked trading is a great way to trade, right? So for Ichimoku, the first thing I do when I load Ichimoku is I remove the useless lines, right? For me, I look at the clouds. The clouds are the key, right? The clouds are a supporting argument for me. Okay, you notice levels where it just bounces off the clouds, where it just reacts off the cloud. It fails to break out from the cloud over here, fails to break out from the cloud. And when it does break up, it tends to get a little bit of support. If you trade it by itself, you will lose money. Okay, if you trade Ichimoku clouds by themselves, you lose money. But like I say, Ichimoku cloud by itself, it might give you maybe, let's say, it could be a plus maybe 15% if things line up. By itself, you lose money. But if you combine it with other things, there's a chance that, you can move the probability in your favor, right? So again, Cicero, you seem to like to ask the question, what time frame is good for Ichimoku, right? The trick is the time frame which has less noise. Okay, so I tend to prefer time frames like 30 minutes and upwards. Now, okay, so Ichimoku, right? So after I remove them, one thing I'll show you is that we use the cloud for momentum. How we use this on AxiTrader, right? Let's just say we load Aussie dollar, and let me remove my indicator, and let me hide my trade manager. So what you can find there is you can in AxiTrader you can go to trend and click Ichimoku Kinko Hyo. Okay, under colors and visualization, right? By default, you can see this, and it's pretty messy, right? So what you can do is you can go to the indicator list, you can click on it, right? And you can click none. I think what you want to do is the first tree, you want to click none, and you click OK. There you go, and now you have something that is cleaner, right? To more or less just show you where the clouds are, give you a good idea of the clouds. Personally, for me, I use TradingView. Let me see if that. Yeah, I use personally for me, I use TradingView to. I wonder, does this give a better one? Nah, still the same. Yeah. Yeah. Personally, for me, I tend to use TradingView to kind of just find this kind of support and resistance level, right? I know Flavio saying that there are many different parameters. Now, the key to everything is to always use the parameters that everyone is using because everyone is watching it. So 926.52 is, if you're using it as a supporting argument, like I mentioned, right? What you want to do is you want to use something that everyone else is using. The same way, when you guys do your research papers, when you try to answer, right? Imagine you're trying to convince your teacher that right? You're trying to convince your teacher that your answer is like your research is valid, right? And you go on Wikipedia, you're trying to give a citation, right? You want to find something which everyone agrees. All the professors say that, yeah, this research is correct. This hypothesis is correct. You're looking for agreement, right? So the same thing with trading. You want to find something where everyone is agreeing on, not some guy using a funny Ichimoku setting that makes him have like massive clouds and stuff, right? He could be in a world of his own, and that might be his own little proprietary strategy. But if you're using it as a supporting argument, right? We just want to keep things simple. Okay. Now, I like to use it combining them together. So in this case, right, we not only have Ichimoku, but we got 1, we got 2, right? We got kind of like a third one over here, right? We got 3, and then we have the 4th one coming here. This lines up with a Ichimoku cloud over here, bearish Ichimoku cloud. So what I like to do for the clouds is I just treat it as an area, right? I treat it as an area where price might react off, right? So you can see that price had difficulties breaking past this. In this case, it broke past it and then it just took off, right? And of course, this case, price wasn't able to break past the Ichimoku, and when it did break past over here, it found support before it, kind of moved up a little bit more. So for me, I use Ichimoku clouds more as a supporting argument. So in this case, right? In this case, is it the same as using Bollinger Bands? I know Lee has asked that. No, it's very different, right? But you could use Bollinger Bands as one of the supporting arguments too, right? Ichimoku clouds, it's more for momentum. So you notice, yeah, Ichimoku clouds, when I mentioned it earlier, it's more to measure like the momentum of a trade. Bollinger Bands is more to measure the whether something is overbought or oversold. Okay, right? So that's what each Bollinger Bands tend to be more useful for, right? Donjon channels are not bad too, right? Yes, highlight an upcoming support line. Yes, so the thing about Ichimoku, right? The thing about Ichimoku, when you look at it, is interestingly, I'm just going to erase all drawings. I'm just going to remove this second indicator, right? Now, the interesting thing about Ichimoku is that if you look at it over here, it forecasts into the future where the support is going to be. And that is useful for us because there's a little bit of a predictive element to that, right? So yeah, that's the thing about Ichimoku. There's a past and there's a present, and no, there is the future, there's a present, and in some cases there's the past. One of its lines uses the past to kind of indicate where the market is heading to, right? Personally, for me, I would use just the Ichimoku cloud. Okay. So Errol, don't worry. I think it's the I know I'm reaching a 1 hour mark. I need to be very mindful of the time here. It'll probably be uploaded, right? It'll probably be uploaded on XC YouTube. So do keep a watch out for that. Okay. Now okay. Let us continue before we we digress too much. Okay, so combining them together. So in this case, right, I'll show you how I can combine them with supply and demand. So in this case, remember, there's a big level here, right? When it comes down to here, everyone thinks it's going to buy, right? It's going to buy, but then it doesn't work out. It starts to break down. So what is this? This is what we call a pullback resistance. Remember what I told you, right? This is a pullback resistance, right? So what happens is price has now made a pullback. Make a pullback, right? And I usually like to sell from here, right? But now that I made a pullback, it also coincides with the Ichimoku cloud, right? And it actually also coincides with a 23% Fibonacci retracement, right? But anyway, it coincides with the Ichimoku cloud. And what happened from there? It just reacts and it goes down. Of course, this is not the case every time. It's hard to find a setup that looks exactly like this, right? But what I do want to show you or bring your attention to is how you combine. Firstly, you combine the pullback resistance. Secondly, you combine the Ichimoku, right? And third, of course, you combine maybe something like Fibonacci, and then you have you add up the probabilities so that it is increasingly in your favor that you find a good setup. Okay. Now, what is the scene in the future is just for why do you say future them? Jared, yeah, it's a good question asking the concept of Ichimoku, like kind of projecting the thing in the future, right? The only true what I call leading indicators when it comes to trading is, to me, Fibonacci, right? Fibonacci is so let me pull it up here. right? There was this little part here, right? There was this little part here where price is projected into the future. Gerard said that, this is just, price being, in some senses being projected. It is not just price being projected. There's some calculation to it, but I don't use it too much. That's why only when someone brought it up to me, then I would highlight it. To me, what matters the most is where price is currently, right? And how it's behaving there. The only true, we're talking about lagging indicators and we have leading indicators, right? The only true leading indicator to me, right, is actually the Fibonacci, right? Which we can share. We can talk more on that in the future. But yeah, I don't want to confuse you guys too much, right? Narvin is a little bit confused about the thickness of a cloud. Don't worry about the thickness of a cloud, right? All you need to know is that you just treat the cloud, oh, that's nice, putting it as blue is nice. Yeah, just treat the cloud as support or resistance. If it's below price, it's support. If it's above price, it is resistance. The bigger the cloud is, technically, the stronger the resistance, right? When there's more cloud, there tends to be more rain, right? Small clouds are weak, it's just a short rainfall and it's, maybe a passing shower. But if it's a big cloud, there tends to be, it tends to be stronger. That's all you need to know when it comes to Ichimoku. Okay. Now let's not digress too far. Okay. Now, guys, one thing I want to show you guys is this support resistance indicator that we've built, or rather I've built, and in partnership with Axie, it helps me find the pullback, the overlap, the swing low support levels, right? So in this case over here, let me see if I can show you guys, right? So you can see how the indicator, right, has actually helped me find one big swing low over here and another swing low that is slightly lower. So it actually combined the whole area for me over here. Okay, the same thing over here, it has one big resistance over here, right? And then there was another big resistance over here, right? So it actually combined it, and now it's showing that this is a pullback support for price for us to look forward to. Same thing over here, is where this was a breakout. We're waiting for price to make a pullback to this level. It shows you the different time frames by the side, how good, like whether it's on the 4-hour time frame or the 1-hour time frame. And one of the cool features that this has, right, is that you get to toggle the strength, right? So if I only want to see things that have been confirmed by more than one levels, I can click this thing called toggle strength. And if I want to add on, right, if I want to add on different time frames, I can just very easily load the 1-hour time frame here, right? I can see where the key levels on the 1-hour chart, where I can see what are the key levels on the 30-minute chart. I can see what are the key levels on the 15-minute, the 5-minute, and the 1-minute, right? But we don't want to go too crazy with that, all right? So we just look at maybe the up to the 30 minutes, 30 minutes, 1 hour and 4 hours, right? So what I noticed is that 30 minutes, 1 hour, and 4 hours, they all seem to show a very strong level of support over here, right? All of them are lining up strongly over here. This is the key level which I'll probably look at. If I do something like Fibonacci retracement from here to here, right? The 38% retracement lines up nicely there. The 61.8 retracement lines up nicely there. And this is how I trade, right? This is how I trade, right? I just look for different setups and look for confluence, right? So this can be used on multiple different kind of currencies, right? So in this case, you can see it's like this is on the 4-hour chart. This is on the pound dollar. This is on the pound dollar 4-hour chart. You can see that there was one big level over here, and then price made a pullback and it became a overlap support. It automatically identifies the overlap support over there, right? And if I want to look at the higher time frames, I can click, and there you go. It tells me that there's actually a bigger level, above here, which I should keep an eye on. So it's pretty useful when it comes to trading and just finding all these key support and resistance, right? So Peter is asking, is this a public indicator, right? No, it's not, right? It's actually a proprietary indicator I built, right? And in collaboration with XC, right, what I'm doing is we are giving it out for free, right? We rarely ever do this, honestly, but we're giving it out for free, right? What all you need to do is that all you need to open a free XC Live account. If you don't have an account, if you don't have an account, how do I copy this in? Yeah, if you don't have an account, you can go to this link over here, right? I'm going to copy and paste it for you guys. This is the link. This is the link. This is the link that you can go to if you want to open an account. If you are an existing account holder, right? If you have an existing XC account, all you need to do is to deposit a minimum of 250 USD. Drop an email to service@xc.com and telling them that, hey, there was this webinar offer for the TFA support and resistance indicator, right? And don't forget to include your account number, because I will specially activate it for you. Right? I'll specially activate it for you so that you can use it. Right? This is this indicator outside of here. It costs 150 USD. Right? And I think this is a pretty good promotion, because you're not spending any money on it. You're just putting money into your trading account, which you can use to trade anyway. Right? Just do me a favor. Don't put in $250 and withdraw it the next day. Actually, it's gonna kill me if you do that. Right? So just put in the money, and you can test out the indicator, to trade a bit more. Right? So Richard is saying that I already have $1 grand in his account. Well, Richard, you need to just put in an additional 250. So this is to be fair for all traders, whether you're new or you're existing account holder of XC. As long as you put in $250 after seeing this webinar today, just tell them that email service@xc.com and they will activate it for you. Okay, so we got a question saying, how long does a 4-hour trade go for? Will you be able to close your trade that day? So we got a question saying that if you trade on the 4-hour charts, how long do you hold your trade for? Right? It's a tricky question, because on the 4-hour charts, if the markets don't move, right? If the markets don't move, your trade can be held for weeks and it still doesn't close, right? So there is no fixed answer to that. Rather, what I want to let you know is that when it comes to trading, right? On the 4-hour charts is slightly, 6 bars in Forex create a 4-hour chart. So if you could, you could be trading, if it takes an average of like 30 bars for price to reach a target, if you're trading on the 4-hour chart, that could mean 5 days. If you're trading on the 1-hour chart, that might mean 1 day, right? So hope you understand the concept behind that, right? So Jose has emailed Jose Ramirez. Okay, all right, don't worry. I see that if you drop an email to service@xc already, I'll ping them and let them know. I'll score them if it's needed, right? You just need to let everyone know that. Jia@xc, yeah, Jia is a nice girl. Is there a time limit for this offer? Just that I don't know when I go live. John, I believe there's a little bit of a time limit for this offer. So if I were you, I would just put in the $250 first, but I don't need to use it to trade straight away. You know what I mean? Right? You can just secure the promotion first. And because I think each week we run a different promotion, and we're towards the end of the week here, so this probably won't last for very long. So yeah, just secure it first, and in the future, then you use it to trade. Okay, Jose, I'll make sure that if Guinea checks up on that. Okay. Now, guys, continue sending questions. One thing I want you guys to do, right, is that we have a guide to indicators over here, right? So I wrote a long book on indicators, right? So it's a pretty good book sharing about a little bit more about the indicators that we've used today, and also on some of the other indicators that like stochastic RSI, the different ways that I use them, and how you can combine them in your trading strategy. Okay. Oh, I see you've already read it. That's great. How do I send this message through? Yeah, okay. So if you want, you can head over to there, guys. Download it, right? And it's a pretty good book. I hope you guys like it. Okay. Gerard, Gerard, yeah, if you search for it, you can find it. But yeah, Axis is a great broker to to use, especially because they have this special collaboration where it's free. So I say give it a shot first. At least you know whether you like the indicator and it works for you, right? So how long do you own it? No, the indicator doesn't expire. As long as you use it on your XC account, it lasts forever. I know it's a crazy deal because, right? Yeah, it's a pretty good deal, honestly. Right? You get a lifetime access for it. People pay 130 USD per year just for this, just to renew it every year. So you get it for free on a lifetime basis with XC. I think honestly, it's a pretty good deal to consider. That's a good question, Jared. I think you need to ask them. Right, my account is in Australian dollars. Can I qualify AUD? So yeah, if your account is in Australian dollars, like Fidelis, right? Yeah, you just need to convert it to from 250 USD to AUD, and it will be fine. Okay. Now, guys, last thing I want to do, and this I always ask this at the end of each webinar, right? Please take a moment and take a moment and maybe just comment in the section how you rate this webinar from 1 to 5. Right, 1 means it is terrible. 5 means that I've done well. Don't worry, like I say, if you vote 1, although I can see your name, I will not hunt you down, right? But at least share with me what you like about the webinar and give me 1 tip on how I can improve. If you think I'm perfect, that is great, right? But if you can share with me, how you think I can improve, that'd be great too. And yeah, if you vote 4 or 5, you can share with me, so that I can always try to improve at least for the next 2 upcoming webinars, right? Okay. Please, now you guys are the judges. You can you can judge me, right? I don't hold anything against you guys. Okay, I see some. Oh, Xiang Chao has gave me a 10. Thank you very much. Yeah. Gerard, right? That is a separate conversation. We probably have it have it otherwise. Thank you very much, guys. Right. Not a lot. That's good. Can see how many. Okay, I can see some people are interested to see how I can determine my entry and exits. Right. Join me for the next few webinars. Right. Let me see if I can find them. Right. If you go on xc.com, you can actually find the upcoming webinars. Yes, under seminars and webinars, right? So do remember to register for them. Next week, we are going to do a deep dive into price action. Then after that, I'll talk to you about managing your trades and designing your strategy. We'll also be giving out a trade manager. So special gifts there. Very, very awesome stuff. So do remember to register, call your friends, right? And this is where we really look at the ways we use, we combine different things to trade better. Right. Clear voice was a bit fast. Okay. Okay. Thanks for your feedback, Lee. Yeah, I agree. We don't really have enough time to cover everything. Right. Probably the next few series we give ourselves a little bit more time to dive a little bit further and do some live kind of live trading together. Right. Thank you very much. Yeah, Milan, I see you registered for both already. Okay, guys. Wow. That was a great time together. We've overran, and I can see about 90% of you guys stayed all the way to the end. So thank you very much. Right. I will see you guys next week. So for now, remember to stay safe. Have a good weekend. Don't spend too much money. All right. Stay safe from COVID. And and cheers and peace out, guys. Take care. Bye-bye.